The Fed just threatened silver, and smart money is buying the dip. Act 1. The Federal Reserve just did something it almost never does. It issued a warning, not about inflation, not about employment, not about the banking sector, about an asset most of their economists don't even track in their primary models. And the market's response was immediate. Silver dropped, volatility spiked, retail investors panicked. But here's what the headlines didn't tell you. In the 72 hours after that drop, while retail was selling, institutional positioning in silver futures moved in the opposite direction. Quietly, methodically, the way smart money always moves when it doesn't want you to notice. This is not a coincidence, and it is not an accident. What you are about to watch is not a silver hype video. There are no price predictions here, no guarantees. What this is an explanation of a structural dynamic in the silver market that has been building for 3 years, that the Fed's recent posture has temporarily obscured, and that a specific class of institutional investors appears to understand far better than the general public. By the time we reach the end of this video, you will understand why the Fed's relationship with silver is more complicated than a simple interest rate story, and why the divergence between what institutions are saying and what they are doing may be the most important signal in the precious metals market right now. Stay with me. This one matters. Act 2. The mystery. Let's start with the thing that should make no sense. Silver demand in 2024 reached levels not seen in over 4 decades. The Silver Institute, the most authoritative data source in the industry, confirmed a structural supply deficit for the 3rd consecutive year, 3 years in a row where the world used more silver than it produced. That is not a short-term blip, that is a pattern. And yet, if you looked at the silver price chart over the same period, you would not see 3 years of relentless upward pressure reflecting that scarcity. You would see volatility. You would see sharp moves up, followed by brutal corrections. You would see a price that, relative to what the supply and demand data says it should be, has repeatedly failed to hold its gains. So the question is, why? Why does a market with structurally insufficient supply, with accelerating industrial demand from solar panels, electric vehicles, defense electronics, and AI manufacturing, why does that market behave as if supply is abundant? The answer is not simple, and anyone who gives you a simple answer to this question is not paying close enough attention. There are at least 3 separate dynamics operating simultaneously in the silver market, and they pull in completely opposite directions. Understanding all 3 is the only way to understand what is actually happening right now. But before we get to those dynamics, there is something you need to understand about the Federal Reserve's role in this story, because it is far more direct than most investors realize. Act 3. Context. To understand the Fed's relationship with silver, you need to go back to 1971. On August 15th of that year, President Nixon appeared on national television and announced that the United States would no longer allow foreign governments to convert their dollar reserves into gold. In a single speech, he severed the last formal link between the US dollar and a physical precious metal. What most people don't realize is what happened next, not just to gold, but to silver. In the decade following 1971, the consumer price index in the United States nearly tripled. Real wages stagnated. The purchasing power of the dollar fell by roughly 50% in 10 years. And silver, the asset that had been used as money for longer than any institution in Washington had existed, went from approximately $1.50 an ounce to nearly $50 an ounce at its peak in January 1980. That is a move of over 3,000% in under a decade. Now, that peak was also driven by the Hunt brothers, a pair of Texas oilmen who attempted to corner the silver market, and whose eventual forced liquidation caused the price to collapse as rapidly as it had risen. That part of the story is real and it matters. We will come back to it. But strip away the Hunt brothers' manipulation, and the underlying move from 1971 to the late 1970s still reflects something fundamental. When the monetary anchor breaks, hard assets reprice. When the credibility of fiat currency comes under pressure, the metals that have served as monetary stores of value throughout human history begin to reflect that pressure. The Federal Reserve knows this history better than anyone, which is why what they said recently, and more importantly, what they did not say, deserves very careful analysis. Act 4. The hidden layer. Here is what the mainstream financial media covered when the Fed made its recent comments that affected silver. They covered the interest rate implications. They covered the inflation narrative. They covered the dollar strength argument. The idea that a hawkish Fed means a stronger dollar, which historically puts pressure on dollar-denominated commodities, including silver. All of that is technically accurate, and all of it misses what is actually important. The interest rate argument for why silver falls when the Fed is hawkish is built on a specific assumption, that silver is primarily a financial asset, a speculation, a trade, rather than a monetary asset with industrial scarcity characteristics. And for the last 20 years, that assumption has largely been correct. Silver has traded more like a leveraged version of gold than like an industrial commodity with genuine supply constraints. But something began shifting in 2020, and by 2022, the shift had become structural. The electrification of the global economy created a demand profile for silver that has no historical precedent. A single solar panel requires approximately 20 grams of silver. The International Energy Agency projected that solar capacity installations globally would continue to expand at a rate requiring silver supply that the mining sector, which takes 10 to 15 years to bring a new major mine online, cannot match at current price levels. Meanwhile, defense spending globally has surged to levels not seen since the Cold War. Silver is a critical component in precision-guided munitions, radar systems, and electronic warfare equipment. The wars in Ukraine and the Middle East are not footnotes in the silver demand story. They are line items. And then there is AI. The server infrastructure required to support large language model training and inference at scale uses silver in its electrical connections at quantities that, aggregated across the global build-out, represent a demand category that did not meaningfully exist 5 years ago. So when the Fed makes a statement that sends silver lower, the question serious investors are asking is not, did the Fed hurt silver? The question is, did the Fed create a buying opportunity in an asset with structural supply constraints that interest rate cycles cannot resolve? That is a fundamentally different question, and the institutional flow data suggests a significant number of large players are answering it the same way. Act 5. Escalation. Now here is where the story gets more complicated and more urgent, because the Fed's threat to silver is not just about interest rates. There is a second dynamic at work, one that connects to the paper silver market, to the COMEX futures exchange, and to a structural feature of how silver prices are actually set that most retail investors have never been explained. The COMEX, the Commodities Exchange in New York, is the primary venue where the global silver price is discovered. When you see a silver spot price quoted anywhere in the world, that price is derived from COMEX futures contracts. Here is the critical thing to understand about those futures contracts. The vast majority of them are never settled in physical silver. Traders buy and sell contracts representing 5,000 ounces of silver, but when the contract expires, most positions are simply rolled forward or closed in cash. The physical silver never changes hands. This means the price of silver is, to a significant degree, set by a paper market, a market where participants are trading claims on silver rather than silver itself. Now, under normal market conditions, this is not a problem. The paper price and the physical price stay close together through a mechanism called arbitrage. If the gap gets too wide, traders step in, buy physical, deliver it against contracts, and close the gap. But what happens when physical silver becomes genuinely difficult to source? What happens when the gap between paper supply and physical supply becomes large enough that arbitrage no longer closes it efficiently? We saw a preview of this in March 2020. During the early COVID panic, silver spot prices briefly collapsed, while simultaneously, physical silver coins and bars became almost impossible to buy at anywhere near those spot prices. Premiums over spot reached 30, 40, even 50% for retail-sized purchases. The paper market said one thing, the physical market said something entirely different. That was a preview, not the main event. The question now, with 3 consecutive years of structural deficit, with industrial demand accelerating, with above-ground investable silver stocks being drawn down, is whether the gap between the paper price and the physical reality is widening again. And we will come back to that. But first, you need to understand a historical episode that rhymes almost perfectly with today, because the consequences then were severe, and they were swift. Act 6. Historical Parallel. Now, this is where the story changes completely. The world is navigating the aftermath of 2 oil shocks. Inflation in the United States has been above 6% for 5 consecutive years. The Federal Reserve, under the previous leadership of Arthur Burns, has been criticised for being too accommodative, for allowing monetary policy to remain too loose for too long. Sound familiar? Paul Volcker becomes Fed chair in August 1979. He immediately signals a fundamental shift. Interest rates are going to rise dramatically, if necessary, to restore credibility to the dollar and crush inflation. The era of easy money is over, and here's what happened to silver in that environment. Before Volcker's tightening campaign truly took hold, in the period when inflation was high, credibility was low, and the dollar's future felt genuinely uncertain, silver ran from approximately $6 an ounce in early 1979 to nearly $50 an ounce by January 1980. That is a 700% move in 12 months. Then Volcker's rates began to bite. The dollar strengthened, real interest rates turned positive, and silver collapsed, falling back toward $10 within months. Two lessons from 1979 that most analysts never discuss together. First, the run-up happened while the Fed was still behind the curve, while inflation was high and monetary credibility was low. The silver move was not despite the inflationary environment, it was because of it. Second, the collapse happened not when rates rose, but when rates rose high enough to restore genuine confidence that inflation was being defeated. That is a different threshold than simply rates are high. Now look at today. The Federal Reserve has raised rates significantly from the near zero levels of 2020 and 2021. But inflation, while it has declined from its 2022 peak, has proven stickier than the Fed's own models predicted. Real rates have been positive, but the Fed's credibility on inflation, in the bond market's view, remains contested. The 10-year break-even inflation rate has not fully returned to the Fed's 2% target on a sustained basis. In other words, we may be closer to 1979 than to 1982, closer to the period of contested credibility than to the period of confirmed victory. And in 1979, silver knew that before anyone else did. Act 7. Present-day implication. Let's return to now. Because everything we just covered has a direct translation into what is happening in the silver market in the current moment. 3 data points that, when put together, form a picture most mainstream analysis has not assembled. Data point 1. The gold-silver ratio. The gold-silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, across centuries of monetary history, this ratio has averaged somewhere between 15 and 20 to 1. In the modern era, the long-term average sits closer to 60 to 1. As of recent months, the gold-silver ratio has been trading above 80 to 1 in various periods, meaning silver, relative to gold, has been historically cheap. Every major cycle over the past 40 years where the ratio has reached these levels has eventually seen silver outperform gold significantly as the ratio mean reverts. That is not a certainty. It is a historical pattern, but it is a pattern with a very consistent track record. Data point 2. Central bank gold buying. Central banks globally have been purchasing gold at the highest rate in over 50 years. The World Gold Council has confirmed this trend across multiple consecutive quarters. Now, why does central bank gold buying matter for silver? Because it reflects a deliberate institutional decision to hold monetary metal outside the dollar system. Countries accumulating gold, China, Russia, Turkey, India, and dozens of smaller nations, are making a statement about their long-term confidence in the US dollar as the world's reserve currency. They are building a hedge, and silver, historically, has followed gold's monetary repricing, often with greater percentage magnitude. Data point 3. Mining supply constraints. Global silver mine production has been essentially flat for several years. The major silver-producing regions, Mexico, Peru, Chile, are facing a combination of resource nationalism, regulatory delays, rising extraction costs, and geological depletion at existing mines. Bringing new supply online takes years and billions of dollars. Price signals at current levels are not sufficient to incentivize the investment needed to close the supply gap. Put these 3 data points together: a historically wide gold-silver ratio, accelerating central bank monetary metal accumulation, and structurally constrained mining supply against industrially accelerating demand. And then ask yourself, what does the Fed's recent posture actually change about any of those 3 fundamentals? The answer, when you examine it carefully, is less than the short-term price movement suggests. Act 8. Future scenarios. Let's be precise about what could happen from here. Not predictions, scenarios built on the evidence we have assembled. Scenario 1. The Fed succeeds. In this scenario, the Federal Reserve maintains its current posture, inflation returns sustainably to target, real interest rates remain positive, and the dollar remains strong on a relative basis. Silver faces continued headwinds from a strong dollar and reduced inflation hedge demand. But even in this scenario, the industrial demand story does not go away. Solar deployment does not pause because the Fed is hawkish. Defense electronics procurement does not slow because real rates are positive. AI server build-out does not stop because inflation is under control. In this scenario, silver's monetary component faces pressure, but its industrial component continues to grow. Historical precedent suggests that when monetary headwinds eventually ease, even slightly, the compressed industrial spring releases with significant force. Scenario 2. The Fed is forced to pivot. This scenario does not require a crisis, although a crisis would accelerate it. It simply requires that the economic cost of maintaining current rates proves higher than the political and institutional tolerance for that cost. Debt service on US government obligations at current rate levels is consuming a historically unprecedented share of federal revenues. At some point, and markets are actively debating when, the Fed's room to maintain restriction narrows. If rates begin to fall before inflation is convincingly contained, the 1979 pattern becomes relevant again. The period of contested monetary credibility is the period where silver has historically done its most dramatic repricing. Scenario 3. The physical paper divergence accelerates. This is the least discussed and potentially most consequential scenario. If industrial and investment demand for physical silver continues to draw down above-ground stocks, and if a catalyst emerges that causes a meaningful number of COMEX futures holders to demand physical delivery rather than cash settlement, the paper price and the physical price could diverge in ways that the current market structure is not equipped to handle smoothly. This is not a prediction. It is a structural vulnerability that exists in the market as currently constructed. The evidence for whether this scenario is approaching would be visible in the level of registered silver in COMEX warehouses, a number that is publicly reported and that analysts who cover this market track closely. None of these scenarios are certain. All of them are grounded in real mechanics and historical precedent. And all of them point toward the same conclusion about what informed investors appear to be doing: building positions while the mainstream narrative creates noise. Act 9. The Smart Viewer section. Here is what separates the people watching this from the people who saw the Fed headline and immediately concluded the silver story was over. The people who bought silver in 1976, 3 years before the big move, looked wrong for a long time. The macro thesis was correct, the timing was early, and early, in hard asset markets, is often indistinguishable from wrong until it isn't. The people who understood the 2008 dynamic in gold and silver, who saw that the Federal Reserve's response to the financial crisis would involve balance sheet expansion at a scale never attempted in peacetime, those people had to hold through significant volatility before the move from 2008 to 2011 rewarded their thesis. The pattern is consistent. Hard asset cycles are long. They are uncomfortable. They reward people who understand the underlying structure and punish people who react to short-term price signals without understanding what drives them. While most retail investors see the Fed headline and see a reason to sell, the structural analysis points towards something different. 3 years of supply deficit. Accelerating industrial demand from sectors that are not discretionary. A gold-silver ratio at historically wide levels. Central banks globally diversifying away from dollar-denominated assets. A mining sector that cannot bring new supply online at current price levels fast enough to close the gap. The Fed created a short-term price event. The fundamentals created a long-term structural condition. Those are not the same thing. And the people who can see the difference between them are positioned differently than the people who cannot. You just spent 23 minutes learning to see the difference. Act 10. We started this video with a statement that was designed to seem contradictory. The Federal Reserve threatens silver, and smart money bought the dip. Now you understand why that is not a contradiction at all. It is a rational response to a market where the short-term price signal and the long-term structural reality have temporarily diverged. Where institutional players with longer time horizons and deeper analytical frameworks see something different in the same data that sent retail investors to the exits. This has happened before, in 1976, in 2008. The pattern is not identical, it never is, but the underlying logic rhymes. When monetary credibility is contested, when industrial demand is structurally unresolvable, when the paper price and the physical reality sit in tension, the eventual resolution has historically not been in the direction of the prevailing short-term narrative. The Federal Reserve is powerful. It controls short-term interest rates. It manages the largest balance sheet in history. It sets the tone for global monetary conditions. None of that is in dispute. But it does not control the rate of solar panel deployment. It does not control the demand for precision munitions. It does not control how long it takes to bring a silver mine from discovery to production. It does not control the decisions of central banks in Beijing, New Delhi, and Ankara about what to hold in reserve. The Fed threatened silver. The fundamentals didn't move. The question worth sitting with, the one that should stay with you after this video ends, is not whether silver will respond to the fundamentals eventually. The question is whether you will be early enough to matter when it does.